Joining us now is John Herrmann, senior fixed income strategist at State Street Global Advisors, and Bloomberg has crunched the numbers, ranking him among the top economic forecasters for the U.S. unemployment rate. John, let me ask you, first of all, about Europe. Get it out of the way here. What are your concerns about the contagion? Because it's clear to see how it could spread to Spain and Portugal, even if Jean-Claude Trichet doesn't really see that. But how could it come across the Atlantic?
You know, what we worry about not just the solvency issue, which is a big issue, but we also worry about liquidity issues and interbank issues. And some of the spreads that we follow show that over the last couple of weeks, they've been creeping up, and they are now like well off their lows and well into an environment that we'd call risk averse. They're not quite at Bear Stearns levels. In particular, we're talking about the LIBOR OIS spreads. They're not really quite at pre-Bear Stearns levels, but they're knocking on the door. And earlier today, we came within 5 basis points of the pre-Bear Stearns levels. So, you know, our concerns about interbank lending, about tighter lending conditions, about slower growth, about the need to raise capital, all these kinds of things. This will spread this shock globally. Not an issue from my standpoint.
Not an issue, John? Because I'm looking at my notes here, and you say there is a risk of a double dip.
You know, what we're thinking about is, no, not an issue, meaning it's not an issue that the banking risk could be spread globally pretty rapidly. So not an issue in that respect.
Okay.
In terms of double dip, we are definitely in the camp that we have had to mark down our second half growth outlook, our earnings outlook for the second half, also the jobs outlook. So we've also stepped up a little bit our unemployment rate outlook for the second half of the year. So we are nervous. We're not going to say we're in the real double dip camp right now.
Right.
We're definitely nervous.
John, help me out here, because, you know, you've been talking to Matt and me for a long time, and you've been very, very bullish. You know, we call you our favorite bull. I mean, you're now saying that the unemployment rate could go above the peak of 10.1% that we've seen. I mean, what has changed so much?
You sound like Lincoln Ellis.
Yeah, I sound like Lincoln. Almost. Thank goodness not. But you know, here's what's going on. On Monday night, believe it or not, we wrote a report and sent it out internally, and then cycled it to our clients in early Tuesday morning. And we basically told people that we were getting nervous about the economy and that we were recommending hedges on long equity positions, which means we were, you know, recommending either taking some profits or, you know, buying puts on the S&P. And our concerns then were only primarily just driven by the fact that consumption in the first quarter was driven by a drawdown in savings and by government transfers, not by income. There wasn't enough income created in the first quarter. So that made us say, wow, you know, we've really got some issues here in terms of income generation. Then, piling on top of that, we now have this issue about Europe. And if you remember, with their debt crisis, about 2 weeks ago, when we were talking about this on your program, we were saying we expected the ECB to actually do some things and to patch the holes, that kind of stuff. And then on Thursday morning, President Trichet, you know, he seemed to drop the ball, to be quite frank. So we're very concerned about this, and we think this is a serious problem. And this is the kind of problem you really have to show up and bring the house, and not really show up and just kind of step into the game. You have to bring the house on this problem.
What do you think Jean-Claude Trichet will do? Do we hear from him on Monday? Do we have some massive quantitative easing ahead of us from the ECB?
You know, he's going to have to really take a chapter out of Ben Bernanke's playbook. We saw just how forceful Ben Bernanke was through the crisis, the subprime crisis, the housing crisis, the crisis with the investment banks. We saw how unbelievably forceful he was, and he broke. You know, actually in real time, he broke many of the laws of the Fed, and then had to sort of retroactively change things and stuff. And you know, that's the kind of thing, that's the kind of forcefulness that you need to see President Trichet do to just, you know, assure investors that this problem is going to be tackled. And even once you start introducing steps
out of the ECB.
Absolutely. And even once you do that, you're still going to take a good 9 to 12 months to just sort of clear out the problems and clear out the mess, and then, you know, get things on track.
Hey, John, speaking of problems and mess, Mohammed El-Arian over at PIMCO yesterday said, you know, don't forget deficits and debt, you know, this all does matter. I mean, when do we realize that the deficits and debt problems here in the United States really do matter?
That may take just a little bit more time past this point, but Mohammed was actually kind of spot on longer term. In the intermediate term, it kind of looked like he might have missed, but longer term, he's definitely nailed this thing. So I think the thing is we have to take his points very seriously. His issues I think are more about solvency. I'm concerned about the issues about liquidity, interbank lending, that kind of stuff, because that ultimately leads to a contraction in credit for businesses and households. So I'm really worried about that transmission mechanism.
It's what happened a couple of years ago, correct? And
exactly.
It's not so far away.
It's not. It could be. It could be here sooner than we'd actually like. So, from our standpoint, the best thing to do is to see very forceful action out of the ECB.
All right, got it. Hey, John, as always, we appreciate you. Take care. Have a great week. And John Herrmann of State Street Global Markets.